Hello, this is Roadmap to Wealth. My name is Carlos McWhorter, CPA, and today I will be doing a stock valuation of Meta. In this video, I'm going to look at the 10K so we can get a great understanding of the business and what their objectives are. We're also going to look at which segments produce the revenue for this company so we can identify what type of company Meta really is. Then we'll do a fundamental analysis, and then we will end the video with a discount cash flow. So to look at Meta is down about 68% since their all-time high of last year. So we'll look at if this company has dropped down enough to where we think it's a good buy or not. So let's get into it. Okay, first, what I love to do when I'm looking at a business is to look at the 10K. The 10K is the annual report, and you have to look at this to understand what the business is. So I go to the business overview section. And here we see in the first few sentences, it says, our mission is to give people the power to build community and bring the world closer together. All of our products, including our apps, share the vision of helping to bring the metaverse to life. So this is a key statement right here. It's talking about, of course, Facebook changed their name to Meta. So we know that they're really committed to building the metaverse, but so much so that they say all of their products, not just their new products that they're developing, but all of their apps, all of their products share the vision of helping to bring the metaverse to life. So we don't know how that's going to look in the future, as Facebook is pretty much in the beginning stages of investing into the metaverse. So we'll see how that plays out. But it's good to note that their whole company, of course, they changed their name to Meta, but their whole vision is about the metaverse. So we'll keep that in mind as we get into the valuation as well. Now, going down a little bit further, it says we report financial results for two segments, Family of Apps and Reality Labs. Now, for Family of Apps, we generate substantially all of our revenue from selling advertising placements to our marketers. This is saying that pretty much Meta is an ad business. They're saying that all of their revenue, or substantially all of their revenue, as we'll see a little bit later, comes from selling ads. So social media ads are what the company focuses on bringing in money. Now let's look at their apps. If you aren't aware, the family of apps of Meta, we have Facebook, Instagram, Messenger, and WhatsApp. I'm sure most of you are familiar with these apps. Also, we have Reality Labs, and it says Reality Labs augmented and virtual reality products help people feel connected anytime, anywhere. MetaQuest lets people defy distance with cutting-edge VR hardware, software, and content. So Reality Labs is pretty much their more specific metaverse developments and investment. So those are the two main segments of the company. Now let's look at the segment revenues to see where the revenue comes from. I don't believe in guessing a whole lot about businesses. This is why I look at the 10K. I look at the segment revenues, and wherever the revenues are coming from, that's the type of business it is. We don't have to make up anything. We don't have to act as if we have to figure out what the business is or what it's becoming. We can just look at the 10K, look at the financials. Looking at the family of apps in this first section, we see that the revenue is $115.6 billion from the family of apps. Looking a little bit over to the right, we see that the Reality Labs revenues are only 2.2 million. So out of the 117 million, we have, looks like about 99% of the revenue coming from their ads in their apps, the family of apps side of the business. So not the metaverse. But one thing we can look at is we see that even though their Reality Labs is only bringing in 2.2 billion, they did spend 12.4 billion in Reality Labs. So they're investing at a loss right now into this company. They're not getting a return into the Reality Labs portion of the business. Of course, I believe they hope that's going to change in the future. Right now, we really don't know when that's going to come to fruition. So we will also keep that in mind as we get into the valuation later on. With every business, I believe there is a significant metric that's kind of unique to the business or the type of business that you need to understand to get a good understanding of what the business is doing and where they are. And here that is users. We see that the daily active people for 2021 increased 8%. Next line, the monthly active people increased 9%. Next line, it says the daily active users increased 5% over the year, and their monthly active users increased 4%. So We see that there's still growth within Facebook as of fiscal year 2021. I will update and do another review when the 2022 financials are released in a few months. But looking at the year over year, as of 21, there was still some growth in their users, which means they should be able to charge more for their ads. And looking at the last line, it says the ad impressions delivered across our family of apps increased by 10% year over year. It says here what I have highlighted, the average price per ad increased by 24% year over year in 2021. I'm very interested to see what that metric is for 22, but as of right now, looking at 21, this shows that this company has continued to grow and their power of creating revenue continues to grow. If they're able to charge more per ad and have more users year over year, this is a good sign for Meta. So we will see how that plays out in a few more months when the new financials come out. So that's the things I wanted to point it out in the 10K. Let's look at the competition. Knowing about the industry that the company is operating in is just as important or even more important about knowing the company. So looking at the revenue, this is most of the market share, $162 billion for ad revenue. So what I did is I looked at the main companies that Meta competes with. I pulled out their specific ad revenue amounts. Now for Snap, I did not do that. That's the whole company's revenues of 4.1 billion. But looking at TikTok, 4.7, Twitter, 4.5 billion, LinkedIn, which is owned by Microsoft, 5 billion in ad revenues, YouTube, which is owned by Alphabet, who also owns Google, 28.8 billion in revenue. And looking at Facebook, they have 115.6 billion in revenue, 71% of the total market. So Facebook is clearly dominant when it comes to social media ad revenue. Now, this is not saying that none of these other companies have a chance to continue to grow, but looking at the cushion that Facebook has, I will say that their ad revenue is safe. They are dominant for a reason. It's not by mistake. It's not an accident. I don't see Meta being at risk because of this large cushion that they have over YouTube, which is, they're second in line and they have 18%. A long way to go to catch up to that 115 billion that Meta is at. But of course, we'll see how this plays out and I'll update this in a few more months. Now let's look at the revenues specifically for Meta over the past 5 years to see how they've grown. So over the past 5 years, looking at 2017 to 2021, 138% revenue growth. Looking at the trailing 12 months, this line here, I did this because we're almost at the end of the year, or really at the end of the year, but the full year financials hasn't come out. So looking at the last 12 months, we see that Facebook has not had much growth or for the year. So this is something we're going to keep in mind when we do the valuation. And if you're interested in investing into Meta, this is something that you have to look at. You need to understand why we have this crazy growth year over year. And all of a sudden this year we have kind of a stalling out. Is this a new trend or is this just a hiccup year and the trend of high growth will continue? That's something that we have to figure out. This company, you have revenue growth that averages 24% over the past 5 years. I consider this a high growth company. I'm also including this year of pretty much no growth for 2022, this 0.2%. It's still a 24% average growth over the past 5 years. This is considered a high growth company. Looking at this chart, we see revenue continues to grow. And of course, we have this, the blue line showing the revenue growth and the orange line showing the percent change year over year. And we see this is something to pay attention to, how the growth is pretty much stalling for this year so far. And it's pretty much down to zero. So we have to be mindful when we're doing the valuation, how we want to look at their revenue growth in the future. Now let's look at the margins. Now with margins, we're looking at two things. Gross profit, which is the revenues minus the cost of sales, the cost of producing the product, which shows how efficient the company is. Then we're going to look at operating profit. We're going to look at what's left over after you produce your profit, and then what is left over after you take what is left over after you take care of your selling, general, and admin expenses. And we're going to look at the profitability of the company at that point. So looking at gross profit, it was 35.2 billion in 2017, all the way up to 95.3 in 2021, 171% 5-year growth average, which is amazing. Looking at their margins, they stay above that 80% margin, which is typical for tech companies because tech companies don't have to manufacture, so their gross margins are pretty high. Another thing to note, as we noted before in this, looking at 2022, we don't see any growth there. It's gross profit has dropped down just a little bit. Where revenues were kind of stalled, we see the same with the gross profit. So that is something to keep in mind. 5-year average of 83% gross margins is pretty amazing. Looking at profitability, the operating profit, we have 136% growth rate, where operating profit was 23.6 billion in 2017, all the way to 55.7 in 21. We have to look at this. 22, we're looking at a decrease in gross profit, and this is directly tied to the increased expenditures into the metaverse. So we see it's down about 20 billion, still very profitable at 35.1 billion, but that is at a little bit under 30% when the company is typically at about 49, almost 50% of operating margins. So there's something to note that this increased expenses into developing the metaverse and their metaverse products is going to affect their profitability and their cash flows. Looking at this chart, we can see here that it's pretty much illustrating the same thing. We have gross profit that continues to grow, but it's starting to stall out. And then we have operating profit that grows at a similar pace, but then we see a sharp decrease here for 22. So we will keep that in mind as we move forward. Now let's look at the free cash flow for Meta. Now the free cash flow is the most important number, the most important metric for an investor. It is looking at your cash flow from operations, which is all of the cash that the company has generated from producing its product and selling its product, minus capital expenditures. Now here, capital expenditures represents the amount of reinvestment needed to keep the doors of the business open. So your cash that you generate from your operations minus your capital expenditures is your free cash flow. Now here are the uses for free cash flow and why this number is so important. The uses of free cash flow: reinvestment into the business, paying down debt, acquisitions, acquiring new companies, paying dividends to the shareholders, and share buybacks. So in 2017, we're looking at 17.4 billion in free cash flow, all the way to 2021, which is 39.1 billion in free cash flow. Looking at the last 12 months, looking at the trends for 2022, we see a decline of about 13 billion in free cash flow, which is minus 33%. This is indicative of the increased investment in research and development and capital expenditures into the metaverse. So looking at this chart, we kind of see a similar trend to the revenues and the margins, where we have strong growth. Then we have this either stalling out or sharp decline in 2022. Now looking at leverage. Now, when I say leverage, I'm looking at how much debt does the company have compared to its free cash flow. Also looking at the strength of the company. Now, I like to look at the debt to equity. Debt to equity ratio of a strong company or a strong balance sheet will have a debt to equity ratio of 25% or below. We see that Meta definitely has a strong balance sheet. 2017 and 18, no long-term debt. Took out some debt in 2019 and averaging about 6.3 billion in debt for the past 5 years, with an average equity balance of 109 billion. We look at the debt to equity ratio of 6%, which signifies a very strong balance sheet. Now, comparing that to the free cash flow for these years, Meta can pay off their free cash flow and using the debt to free cash flow ratio in 0.4 years. So we're looking, or 0.3 years. So we're looking at them being able to pay off all of their debt 4 to 5 months. So we see that this company remains in a great leverage position. Now, let's get into the discount cash flow to see if this company, in our opinion, is trading at a discount right now. Now, because Meta is investing so much into the metaverse, and they're very committed to do so, as we saw in their financial statements, it is difficult to project the growth rate of the free cash flows of the company. Because of that, just trying to be conservative, I'm going to say I believe Meta is going to increase their R&D and capital expenditures, probably in line with the increase in revenues. I believe their ad revenue is safe because they're so dominant in that area, and the social media ad space is growing pretty rapidly. So I believe they'll continue to get revenues, but as far as what cash flow is going to remain is a big question mark there. So for the first 5 years and for 10 years, I'm just going to say no growth. If they can produce $39 billion in free cash flow as they have been producing, with a discount rate of 10%, and also trying to think of, okay, in the future, what if I can sell this company for 10 times free cash flow? Strong companies, we look at selling it for 15 times free cash flow. Weaker companies, 10 times. Do I think Meta is a weak company? No, I just think that so much is changing. So to be more conservative, I'm going to leave that at 10. I'm going to say Meta is probably worth right now $391 billion in their market cap. Right now, they are trading for $319 billion, which means that they're undervalued by about 23%. Now, just looking at the scenario, if I believe that there's even more risk to Meta's free cash flow because of the metaverse spending, I can say, okay, I'm going to project minus 10% of free cash flow for the first 5 years, and maybe minus 5% for 5 years after that. If I do that, Meta is only worth $253 billion today, and they're trading at 319, which means they are overvalued by about 21%. So with this sheet, if you're doing a discount cash flow, what you're doing is you're making assumptions about a business, assumptions about the future. You're guessing. There's no real right or wrong answer. There may be some answers that are more reasonable than others, but you want to make reasonable assumptions about the future of the business. And because pretty much the fundamentals of the business is kind of changing right before our eyes. So because the fundamentals are changing, it's hard to project what the fundamentals are going to be in the future. So with that, semi-comfortable projecting no growth. I would be more conservative and say I'm going to project minus free cash flow growth for the next 10 years, just to be safe. And looking at it this way, I think the value is worth about $296 billion. So right now they're close to being fairly valued, maybe a little bit overvalued because of so much uncertainty that they're bringing forth. Now, I don't believe it's a high risk investment because, again, the ad revenue, which is 98% of their revenue, is, I believe, safe. But because the fundamentals of the company is changing, their focus is changing, it raises the level of uncertainty to a very high rate to where, as a sound investor, I'm not really comfortable with that investment right now. So with that being said, I would say Facebook is overvalued by about 7%. Again, I could be wrong because we're making assumptions about the future. We will continue to, evaluate and look at it because they're such a dominant in their ad revenue space. So this is something that, as they continue to drop in market cap, as the stock price continues to drop, this is possible to get into a range of a possible investment or a possible safe investment, as I believe the lower the price, of course, the lower the risk that you're taking. So if the risk can get low enough for me, then I can consider this as an investment. As of right now, I'm going to leave it alone. So that's all for this video. I hope you liked it. I hope you learned something and saw something valuable. If you did, please consider hitting the like button and subscribing to my channel. I plan on doing so much more stock analysis and valuations in the future. And also do me a favor and share this video to an investor who needs to hear this information. Look, I appreciate you joining me, and I look forward to seeing you in the next video.